So as a consequence of that significant CapEx program, what we've seen is a strongly increasing asset base. So this shows how the asset base has been growing, and you can see it's more than doubled over the last few years, and we're currently just over $5 billion. And with a regulated business like Transpower, that is the principal driver of Transpower's revenue growth. So we our revenue is driven by a growing asset base, both driving return on those assets and then the depreciation to recover the capital that's been invested in the business. So along with that growth in the asset base, we've seen strong growth in revenue over the last few years, or particularly over the last few years, as those major projects have been completed, commissioned, and have moved into the regulated asset base. Going forward, we expect a much more muted outlook for revenue in the future, and that's simply a function of the fact that we won't have that same level of growth in the regulated asset base with a much lower capital investment program in the future. Exactly what that outlook looks like depends on a number of factors and pending regulatory decisions, most importantly of which are the decisions from the Commerce Commission in terms of the allowances that we will have for capital and operating expenditure in regulatory control period 2, which we'll expect to hear about at the end of this month, and then subsequently to that, the decision on the regulated rate of return to apply in RCP2, which we expect to hear about in October. So taking that revenue line, of the strong growth there, in conjunction with that, and this is perhaps not unsurprising for a capital-intensive business, we haven't seen the same growth in our operating expenditure. The focus is very much on controlling and seeking to reduce operating expenditure going forward, but that's given us a strongly widening operating margin over the last few years, and the challenge is to hang on to that increased margin going forward when we won't have the same benefit of growing revenue that we've had over the last few years. The consequence of that widening of the growth in revenue and the but relatively flat operating expenditure, of course, is significant growth in EBITDAIF. As I mentioned, $717 million in the 13-14 year. Again, it would be unrealistic to expect that trend to continue going forward, given that we won't have that same top-line growth in revenue that we've had over the last few years. Along with, of course, the growth in EBITDAIF comes strongly increasing cash flow. Our net cash flow from operations this year, so that's after tax, was $443 million. As a consequence of that, we've pretty much reached the point now where we expect to be largely self-sufficient in cash flow terms going forward. So given that cash flow and our CapEx requirements, we don't expect to see the same level or same increase in the level of borrowings that we've had in previous years. So what you're seeing here is a growth in total debt to about $3.3 billion at year end, and we expect that to be pretty close to our peak funding requirement going forward. That, as I mentioned, has been one of the strong drivers of the increase in our finance expenses over the last few years. But coupled with that, as shown on this graph, is that much lower level of capitalised interest. So you'll see there at the peak of the investment cycle, we were capitalising almost half of our interest, our finance expenses, but that's dropping sharply as we move through to the end of the major capital investment program, and therefore you're seeing much more of that finance cost coming through into the income statement and driving that increase in financing expenses that we've seen in the last 2 years. In terms of our funding, so as I mentioned, we're close to peak levels of debt, and that means that our borrowing requirements are principally for refinancing. And what this chart endeavours to show is that we have a range of maturities in our financing, so diversity in both in terms of the markets in which we borrow and also the tenor of those maturities. So looking at over 15 years, these are the maturities, and they're split between the main markets in which we have borrowed historically and which we expect to continue going forward. So primarily the New Zealand domestic market, which accounts for about 40% of our outstanding debt. Then the Australian, the AMTN, Australian medium-term note market, the US private placement market, and then some other currencies, in this case largely Canadian dollars. But going forward, our focus will be primarily on the New Zealand domestic market, and we hope to see a growing presence in the AMTN, the Aussie dollar market, which is not only a good way of tapping the Australian investor base, but also gives us access to the investment pool in Asia, and the Asian investors have participated strongly in our inaugural issues into the AMTN market. In the last year, we had refinancings or borrowings of $540 million, and that was split between the domestic market and the AMTN market. And most recently, we had a refinancing of a maturity at the beginning of this year, which again we placed into the Australian dollar market, $150 million to replace a Swiss issue which matured in August of this year. So that's our outlook for debt funding. In conjunction with that, I just wanted to touch on capital structure. So another important aspect of operating efficiently is to make sure we have not only efficient cost base, but also an efficient capital structure. Over the last few years, through enhanced level of dividends, we have adjusted the capital base to be approximately 70% debt funded, 30% equity. And we believe that's a prudent level for a business like Transpower, and to minimise our weighted average cost of capital overall. It's consistent with the nature of the business that we operate, with a high level of regulated revenue, so certainty over future cash flows. What you see here is Transpower's leverage, which I mentioned is around 70% currently, compared to a peer group of international transmission companies. So these are companies very similar to Transpower, typically single business companies with operating national grids that will typically have, as a consequence of that, also very high levels of regulated revenue. And you can see Transpower's gearing at about 70% is very much consistent with that peer group. So finally, just to recap, this is the trend in our preferred measure of profit, so that's net profit after tax before changes in the fair value of financial instruments. As I mentioned, strong drivers this year have been the increasing revenue from as the assets, the last of the major projects have been commissioned. Good control on operating expenditure, driving that increase in EBITDAIF up 15%. Offsetting that, we've had higher depreciation and write-offs and higher finance expenses, so overall down 9% at $184 million. Finally, just by way of summary and outlook, so it's been a satisfactory year financially for Transpower. We've performed in line with our business plan and budgets. We have a sound balance sheet with 70% gearing, a level we feel comfortable with, and a capital investment program going forward which is at significantly lower levels than we've been facing in the recent past. As I mentioned, future financial performance is strongly dependent on some important regulatory decisions which are forthcoming. So as I mentioned, we have the final decisions from the Commerce Commission at the end of this month on our expenditure allowances for regulatory control period 2. In October we will hear what our regulated return is to apply for that same regulatory control period, and then we still have pending the decision also from the Commerce Commission on our application for increased funding in respect of the North Island Grid Upgrade project as well. There, of course, now matters which are largely beyond our influence. So in terms of what we can control and manage, the emphasis for us is on controlling the cost base, looking to reduce operating expenditure where we can, and also to optimise our decisions both in terms of where we spend our OPEX, but also how we prioritise our capital expenditure. And that's probably a good note to hand over to Alison.